You're watching News.Markets. There's been a wave of volatility on the Forex commodity block lately. In fact, 4 of the worst performing G10 currencies since this time last year have been those countries that export large amounts of commodities: Canada, Australia and New Zealand, and the Norwegian krone. Well, Angus Campbell, senior analyst at FX Pro, joins me now. Thanks ever so much for coming in. Let's walk through what's been going on Forex markets. A couple of big central bank meetings. What's on your radar?
Well, I think what's very, very clear, obviously, is that everyone's been focusing on one thing only, and that's the Federal Reserve. But you have to remember that that decision, when it comes, of course, there's great debate as to whether it will be next week or towards the end of this year or even next year. That's going to have an effect on many, many markets. We're already seeing that playing out. It's not just that issue that really is dominating FX markets at the moment. It's also this China problem in terms of the Chinese economy slowing. It's clearly having a huge impact on equity markets, fixed income markets, and of course currency markets as well. Because, as you say, there are a number of currencies that are sort of given the sort of term as being a commodity currency. So those sort of countries that export a huge amount of metals for industrial purposes and other commodities such as oil, and they are weakening quite significantly because their biggest client, i.e. China, and the Asian region is slowing, and it's slowing more so than people perhaps had previously foreseen. So the likes of the Australian dollar, New Zealand, Kiwi.
Who's the most vulnerable?
Well, I think at the moment you've got. It's interesting because when you look at the Antipodean currencies, so the Australian dollar and the New Zealand dollar, they've had a big battle against each other recently, and last year you saw the New Zealand dollar strengthening because their central bank was actually tightening monetary policy. It was raising interest rates. It's now unwinding that because of what's been happening recently in the financial markets. They've had a bit of a double whammy, really, because their economy is slowing as a result of the weakening commodity prices, but also one of their biggest commodities, of course, is milk. And we all know here in the UK, of course, with farmers taking cows into supermarkets and just how low the price of milk is. So it's having a really detrimental effect on the New Zealand economy. So their currency, as a result, has weakened quite significantly, and weakened even further overnight when they recently just cut interest rates.
What about the Canadian dollar?
So the Canadian dollar has sort of been through that process. It's been kind of ahead of the game. The Reserve Bank of New Zealand its critics are saying, it was a bit slow to act and really probably shouldn't have tightened last year anyway. The Canadian dollar has weakened significantly, in particular against the US dollar, because of course of that commodity link. Yet really that weakness seems to be slowing down. Its base rates are at 0.5%, and indeed their statement was almost kind of encouraging. They're seeing things just turn around a little bit, and again there's this great debate as to whether maybe they will perhaps cut again later this year or early next year, or just keep rates at 0.5%. So in terms of the Canadian dollar, things seem to have just maybe slowed down. At least the pace of weakening seems to have slowed down.
I have to ask you, because you have taken holidays, and that's when the biggest moves have happened on the currency markets. Of course, there was the Swiss franc. Then more recently, there was all the concerns over China. Bearing in mind your own vacation schedule, what's the worst thing that could happen in currency markets now?
I think the worst thing could be me going on holiday. But apart from that, is if the Federal Reserve really surprises the markets by if they hike rates, that won't be a surprise. But if they go really hawkish and say hike by 0.5 percentage point, which certainly is not my view or my opinion, but there are people in the market that think that A, they should do that, and B, they will, which is quite surprising. But if they do that, I think that will send shockwaves through the financial markets. Now, I don't think they want to do that, given what we've been through in the last few weeks. Because I think that things probably will get worse before they get better. I'm not talking Lehman Brothers type stuff. I'm talking, I think that that China is slowing very, very quickly. And I think the markets haven't appreciated that yet. So I think there is probably certainly room for more turmoil, heightened volatility, and possibly downside to equities. But in terms of, and as a result, the Fed, who have made it very, very clear, of course, their remit has always been protect the US economy, look after the domestic economy. But even this year, they've just becoming more and more concerned with the global picture. We are in a global economy now. And I think if they were to raise rates next week, I think that would send the wrong message to the financial markets.
So investors should brace for turmoil, but possibly not any move on rates soon. Angus Campbell from FX Pro, thanks ever so much.
Pleasure.